Hi, everyone. As you're joining in, we're going to give people about a minute before we get started here. Um, so yeah, just hold tight and we'll get started any minute here. Alrighty, and I'm going to get started with a quick introduction. Today, we have Introduction to Farmland Investing brought to us by Gold Leaf Farming. And before we get started, I am going to read a quick disclosure. The views expressed by speakers at the Camaplan webinars are those of the speakers only and may not reflect those of Camaplan, its members, or employees. Camaplan does not guarantee the accuracy of information provided by the speakers or attendees. Professional advisors should be consulted before implementing any options presented. CAMA absolutely does not endorse or recommend any individual or organization, including the speakers. CAMA, its members, and employees do not accept liability for losses and/or damages arising from errors or omissions within, reliance upon, or any use of the information provided by the speakers. Individuals are strongly encouraged by Camaplan to conduct their own due diligence before making any investment choices. CAMA does not act as, nor offer the services of, an investment advisor, CPA, realtor, or attorney. If tax, legal, accounting, investment, or other similar expert assistance is required, the services of a competent professional should be sought. And this is the contact information for one of our sales representatives on the screen right now. His name's William Mucker. You can reach out to him via email at engage@camaplan.com or by phone number at 866-559-4430. And now I am going to turn it over to Josh from Gold Leaf, and he is going to talk to us about Farmland. So take it away.
Perfect. Well, hey guys, thanks so much for joining. My name is Josh Guggenheim. I am the head of acquisitions here at Gold Leaf Farming, based in California. Gold Leaf has been around for about 7 or 8 years now. Our goal is pretty simple. We want to be the best in class sponsor for specialty farmland, and basically be the first call, so to say, for investors who want exposure to specialty farmland. Today, I think we've got an hour. I don't think it's going to be a full hour, but I think I'll probably speak for about 15, 20 minutes, give a few points on why I think specialty farmland is attractive, why we're doing this, and then we can open it up for Q&A. But I guess, Mike, in the meantime, if they have questions, can they put anything in the chat, or how does that work?
Yes, if at any point anyone has any questions, there is a Q&A function that you can put the questions into there, and they will be saved through the end, and I will make sure that all the questions get brought up at the end.
Perfect. Well, appreciate that. Let me see. And hopefully you guys can see the screen, I hope.
That we can.
All right, great. So yeah, like I mentioned, I think there's kind of 3 or 4 questions that I hope to answer in the presentation. Want to talk a little bit about specialty farmland as an asset class, why it's compelling, what it is and why it's compelling. I want to talk about GLF, why we got started, why we're doing what we're doing, and what our investment product looks like. And then, last but not least, I want to talk about why now. I think there's some pretty interesting timing angles in regards to our product right now, and that's important for investors to know. And then that should be 15, 20 minutes, and then we'll get to questions and answers. So, zooming back, why specialty farmland? I think we can, take it a step back and talk about what makes a good investment in general. I would say these are four rules that probably apply to most investments. They particularly apply to real estate or real asset investments too. So, to explain them, I think if you get all four of these right, there's a really good chance your investment will be successful. If you don't get these right, uh, you're basically going to have a hard time. Macro trend is pretty easy. You obviously want to invest in something where the supply and demand trends make sense. Um, in regards to fair pricing, that's a second one. You want to buy stuff that isn't overvalued or overpriced, I would say. I think it was Warren Buffett who said there's a lot of great investments or good companies that where the investment has been undone by a price that's too high. That's exactly how we see investing too. The third angle here is really the value creation opportunity. And what that means is once you make the investment, can you actually improve it? Can you improve the cash flow? Um, in the multifamily world, this is all about, rent growth. If you can grow rents, you can do pretty well. If you're limited on your ability to grow rents and drive more NOI, your upside's really limited. And last but not least, tax efficiency, right? So you don't want to have a good investment and then give everything back to the government, probably. Um, when you can invest tax efficiently, you keep more of your upside, obviously, and that's really important, especially over a long hold period. So how does specialty farmland fit within these kind of four components? In regards to the macro trends, we're in a pretty interesting supply and demand dynamic, right? So there's more and more people eating more and more calories, and there's less and less farmland, right? Because farmland is being converted from farmland to urban use or getting taken out of use. At the same time, the world will basically have to produce more food in the next 40 years than we have in the last 10,000. So you basically have a premium for farmland because we need more and more of it to produce the and farms and food, but we have less and less of it. So as I'll show later, that's been driving some pretty good appreciation. In regards to fair pricing, we are able to buy some of our specialty farmland at 10, 11, 12% cap rates, almost double what you see other real estate trading at. So we're excited by this. It's a good price. And you really get paid in specialty farmland for the risk that you're taking. Back to my multifamily example, it's kind of crazy. You're seeing, some multifamily still trading at, let's say, 5% cap rates. I'm not sure if that really makes sense to invest into that when a 10-year treasury or other short-term treasuries are yielding close to that. So fortunately, still in specialty farmland, there's a low price and a risk premium that you get paid for taking the risk. In value creation, most of these farms that we're buying, they're basically from older farmers who haven't invested that much in them. And there's a lot of farmland out there that will basically be switching hands in the next 20 years. We think it's something like 2/3 of the whole country's farmland will go through a sale in the next 20 years. That's important for us because there's a lot of low-hanging fruit, no pun intended, on these farms when we buy them, and we can buy them, improve the NOI, and that's good for returns. And last but not least, tax efficiency. So when we're buying a specialty farm, half of the value is attributed to improvements. All of those improvements can be bonus depreciated. So when you buy the farm, you end up having a really good passive loss in the first couple of years, which offsets income. So I don't know if other folks are familiar with energy investing or maybe manufactured housing. But specialty farmland is no different in regards to being a really good asset class in regards to being tax efficient because of depreciation. So all these trends have been in place. and they've basically driven really good returns in the last few years, right? So if you look at on a 10-year basis, almonds and pistachios, which is where we focus, have done about 14% per year. On a 15-year horizon, they've done about 16% per year. And on a 20-year horizon, they've done about 20% per year. So these trends that we've identified have fortunately resulted in pretty good returns for people who own almonds and pistachios. The problem that we saw, or at least an opportunity maybe that we saw, is that it was really hard for investors to access farmland, both row crop farmland and specialty farmland. If you take a look, only about 2% of specialty farmland is owned by institutional investors today. Compare that with multifamily or office, almost 70% of large multifamily buildings in the country are owned by investors. It's pretty easy, as you guys know, for investors to get access to multifamily or office. It's pretty hard to do it with farmland. And that's the problem that Gold Leaf wants to solve, or was founded to solve. So how we work is we raise investor capital. We have a few different entities, and then we buy farms and operate them within the entities. Right now, we have something like 12,000 acres, which basically range from Yuma, Arizona to the Sacramento area. 95% of them are almonds and pistachios. We also have one date farm. And all the farms that we own, we operate ourselves. So we're buying the farm, we're owning the asset, then our in-house team farms it, and we make money a few ways. Number one, when we sell a crop, we sell it profitably, we collect from the processor, and we issue cash distributions. That's way number one. And then way number two is through land appreciation. We're owning all of the land, it appreciates through our investment. A few other things that I think differentiate us, and we sometimes get questions about, we only do really supply constrained crops. So we basically want to invest in crops that can only grow in certain areas. If you invest in other crops, like let's say wheat or corn, it's fine, but because they can grow throughout the world, when price goes up, a lot of more people plant and supply goes up, which then is a headwind for price. If you can invest in supply constrained crops, when demand goes up, supply can't really keep up with it, driving some pretty good grower economics. Secondly, it's a pretty interesting time for ag tech. There are tons of tools available to farmers that were not available 10 or 20 years ago. Drone orchard flyovers, extreme precision irrigation and automated irrigation, various data science applications too. We also have autonomous tractors, which are pretty cool. We use a lot of this technology, and we think it gives us an operational edge, definitely compared to past farmers, but also compared to our competition that doesn't. And last but not least, we get a lot of questions about water out west. We only buy farms with really strong water situations. That means they have really good surface water rights and good groundwater rights. And we're building a portfolio here with some pretty valuable water rights that we think will appreciate in the future. We've got a pretty big team. We don't need to go through everything here. We've got about 80 folks on the team. It's a mix between maybe 15 or 20 office folks and then 60, 65 operational folks. Like I mentioned, all of our farms are managed by an in-house team, which gives us better operational control than our competitors that basically use a third party or just lease out the farms. As I mentioned, water is pretty important. So what we do is we basically go and we map out, if you see on the right hand here, it's our internal map of all the different water districts in the state. We map them out, and then we overlay the areas with really good yield, and that's how we target the best in class farms. A little bit about the history and why it's an interesting time right now. We've been buying farms for a while now. And back 2 or 3 years ago, we were buying some good farms in kind of the, let's say, 9 to 10% cap rate range. That was fine. But in the past few years, we've been actually finding farms in like the 11, 12, 13% cap rate range. So we're excited about this because as rates have come up, prices have been reflected in our crops, and that isn't necessarily the case for other real estate that we see. I mentioned a little bit about our operational advantage. One big playbook that we use, or playbook item that we use, is an organic conversion. So I don't know how many of you folks eat, organic. Hopefully some of you eat organic almonds, but organic almonds are basically twice the price as conventional. It's very hard to farm organic almonds. Only about 1 or 2% of California almond farmers do it organically because it's so hard. But if you can convert from conventional to organic, you can make a lot more money. So this is an example of a farm. We call it GLF 3. It's located about 5 minutes away from Sacramento Airport, actually. We bought it. It was a conventional farm, and then we turned it into organic over the 3-year process. And what we basically did was we took a farm that was yielding maybe something like 4% on the equity, not great at all, into something that's doing about 30% plus. And it's all because we could capture this organic price premium now. So I'll stop there. I know I left you guys with a lot. What we're looking to do now is we're raising capital into one of our main vehicles. We call it Gold Leaf Farming LP. This partnership currently owns 16 farms throughout California. How it would work is investors invest directly into this partnership. They own equity into the partnership. They get exposure to all the farms that we already own. And then as we raise more capital into the partnership, we will continue to buy more farms. Like I mentioned, there's some really good cap rates out there for farms in California. That's why we're raising capital, so we can go on the offensive and buy some good farms at good prices for now. How it will look is we think this should be basically a kind of high teens net IRR investment. Most of that will be driven by cash flow. So what we do is we harvest the crop once a year. Like I mentioned, we sell it to our customers. When we collect from the customers, we generate cash flow and then send out cash distributions. And then we also will have some land appreciation too. So that's how we think about this. The nice part for investors is if you were to invest, you're investing into assets that we already know, we already farm, and you get exposure really day one. So let me stop there actually. And I guess we can go to some Q&A, if that makes sense, Michael.
Absolutely. So yes, if anyone has any questions, feel free to put them in the question and answer Zoom thing right now, or in the chat, and I will see them and ask them. But to start, I know I had one, and that was obviously I understand the literal difference between a typical like a row crop, like a corn or something, versus kind of what you guys are doing with trees. And I'm curious, like why one over the other? Like, why did you make the choice you did? What's the difference?
Yeah, good point. So, and apologies if I didn't explain that well. A lot of farmland investing is basic row crop, or kind of typical commodity investing. So if you think corn, soybeans, wheat, etc., how that generally works is people just buy the land and then they lease out the land to a local farmer who grows the crop and then basically pays them a lease rate. Ours is a little bit different. We are buying a big farm with trees, generally with an orchard like the one you see right here, and we're basically farming it ourselves. The main difference is that the row crop returns tend to be in the kind of single digits, let's say. It's a good, safe investment for sure. But the specialty farms like wine or apples, almonds, pistachios tend to be kind of more in the teens range returns. They're harder farms to manage, harder farms to find, and investors get compensated for higher returns for that. So that's number one, is the return threshold is a lot better. And then number two is it tends to be that the specialty crops tend to be more supply constrained versus the row crops, which is also where we want to play. So yeah, good question, Michael.
Awesome. And I see two questions in the chat right now. I'm going to ask the first one from Anonymous. Do you have insurance on climate change impacts like wildfires? Very interesting question.
Yeah, good question. So we do have crop insurance every year, which basically protects against if there's like a weather event and there's no crop for a year, we get a payment, and it's a pretty high payment actually. We can insure about 80% of our revenue through crop insurance. So, for example, one year we had a frost on one of our orchards, and we basically got 80% of the revenue from crop insurance, which was great. So we do have that. It's pretty important. In regards to wildfires, that is an interesting question. We don't have any wildfire risk in our portfolio because we're only focused on the Central Valley of California and really heavily irrigated farmland. So we don't really have insurance for that. We don't need it. If we were in wine grapes or something, we would probably want insurance for that because there's more risk. Those grapes could grow in areas where there might be a wildfire, or there's also a risk of smoke taint to the grapes. We don't have any of those risks, and we don't really need insurance. But if we were in different crops, we might.
Makes sense. Next, we have a question from Jim in the chat. Is there a minimum investment amount and or time?
Yeah, good point. So we generally do a 50K minimum into each of our entities. How we think about timing is you invest into the entity, and then we'll look hopefully to generate a liquidity event in year 7 to 10. So what we'll do is we can do a debt finance recap, we can sell the whole portfolio, and that's kind of the timeline here.
Makes sense. Next, from Anonymous again, can you share the 1 year and 5 year returns? Also, can you share what your crop yields look like yearly? It sounds like they are trying to understand how volatile the annual cash flows are.
Okay, yeah, good question. So it's been a mix. So within our portfolio, the almonds have actually been lower returning. Those have probably been like low single-digit returns. And the pistachios have been higher, double-digit returns. The reason being is that pistachio price has been basically about on the 50% median. If you think it's been in line with historical averages, almond price has been low the past couple of years, and that's kind of impacted the general cash flow of the partnership. I think on average we're like with Gold Leaf, we're probably something like 10 to 12% net IRR over the past few years if you look at all of our entities. And all the crops, almonds, pistachios, etc.
Yeah. Can you explain the risks involved and tax benefits with some examples with numbers? What tax documents are provided by the team to get the tax benefits? Do you have any documents from a tax law company that address legality aspect?
Okay, so basically you get a K1 every year. So it's pretty simple. And the K1 basically lists out your share of the partnership income or losses. So that's number one. Number two, I'm not sure really what the legality question is that much, but if you wanted to look it up, if you look up farmland bonus depreciation with improvements, that's basically what we're taking advantage of. When we buy a farm, let's say we buy a farm for $30,000 per acre. Generally, we assign about $15,000 per acre to the land value, which cannot be depreciated. The rest of it, the other 15,000 per acre, can be bonus depreciated. So basically what we do is we take that bonus depreciation, it generates a passive loss, which then is sent out to investors via the K1. And then the next question, I guess, was about the tax law firm. We basically have a CPA firm. Crow does everything for us, taxes, audit, etc.
Awesome. A follow-up question on climate change. How soon are you planning to get wildfire insurance because of changes?
Probably never, because we're growing, where we're growing these crops is basically in an area where there's never once been a wildfire. You can look at kind of the past California wildfire maps, and they're like heavily irrigated crops. So these crops need a lot of water to grow, and fires just don't take place, where these crops grow. If we were growing in other areas where there are wildfires, we would have done it yesterday, but it's just not really a risk for the crops.
A question from Matt Hale. Are there tax or legal implications involved with investing in a California entity not seen with investing in farmland in other states?
Not really. Yeah, not really. California actually has a or a favorable enough tax code in regards to farming. It's like, one example for that is this thing called the Williamson Act within California. And basically what it does is it gives you significantly lower property taxes if you own ag land in California versus other types of real estate. So there really isn't anything, I would say, detrimental. And actually, the state is relatively supportive of ag from a tax perspective.
Awesome. And then another question from Jim. I missed your answer to other specialty crops. Will you be purchasing other specialty crops to diversify? Are pot, dates, or hemp possible?
Good question. I think, we'll do a few more crops in the future. I don't think we're in any rush. I think we've looked at hazelnuts, we've looked at olives, we've done a bit of work in citrus as well. We have also looked at some grape deals. So I think we'll probably end up getting from the kind of two focus crops that we have right now to probably 4 or 5 in the future to diversify a bit. But we don't want to be a company that does, 20 different crops and do all of them just average. We want to be more, do a few smaller crops, really do them well, and be experts then in them. The other thing that I wanted to mention was it's really important to look at global cost of production. So what that means is, like, how much does it cost you to produce a pound of almonds or pistachios or grapes or whatever? In California, we basically have the best cost of production for almonds and pistachios and a few other crops, which is why we want to invest in them, because we have the best global margins. We don't want to buy other crops where we wouldn't have that. Like, for example, there's avocados in California. Those avocados in California yield, they probably cost about 40% more to farm than in other areas, and they yield about 40% less than in Mexico and South America. So we would never buy California avocados, because out of the gate, we're not competitive from a cost of production standpoint. We want to focus on crops where, in our backyard, we're kind of global leaders.
Gotcha. Yeah, and it sounds like there is agreement in the chat as well. Alrighty. Well, if anyone else has any questions, feel free to send them forward now. Other than that, it looks like we are running out of questions. So I will open it up to you, Josh. Is there anything else that you wanted to touch upon? Give people another minute to ask any questions before we head out of here.
Not so much. I think if anyone is interested, you can definitely contact me at josh@goldleaf.ag or send us a note at investors@goldleaf.ag. We know we gave you a lot of random information about cost of production and depreciation and various other things. So and I realize most people don't spend their days thinking about this stuff. So if you're interested, reach out. We're happy to do another call or presentation or get you in touch with the farming team or anything you'd like. Um, but yeah, please do that. We're raising now, so probably sooner the better. But no, any more questions, comments, concerns, feedback, anything is
Uh,
more than welcome. Just email us.
two, if you have a second,
I
two
do, yeah.
more questions came in.
Oh, good.
We've been looking at investing in farm credit system bonds. Can you explain how your farming plays into the farm credit system?
Yeah, sure. So basically, we do use some debt on our farms. Good question. We generally use lower leverage than in other real estate asset classes. We use maybe 40 to 50% LTV. How it works is we have a local bank. We use a few of them, but one that we use a lot is called American Ag Credit. We also use Calusa, Glen, and a few other ones, but basically local farm credit banks. Those banks basically originate the loans to us, and then sometimes they sell the loans to the farm credit system. So how it generally works is it's similar to like Fannie or Freddie Mae with like conventional real estate, where Fannie or Freddie will basically take these loans off of off of banks' balance sheets. The farmer's credit system does that same thing with conventional ag loans, that are basically going to local farmers like us, generated by local, farming credit unions, if you will, and then sold back to the, credit system.
Awesome. And then the last question we've got, did you touch upon demand? Is the demand for almonds and not sure what exactly that word is, increasing by consumer?
Yeah, good question. So there's kind of two stories with the demand for almonds and pistachios.
Pistachios, thank you.
Um, yeah, with almonds, we basically have about 70% of the product is actually exported, 30% stays in the US. The US consumption is growing at kind of like low single digits. There was a lot of growth in almond demand in the US in the past 10 years, but right now it's basically growing low single digits. But there's a lot of demand in the emerging markets. So, like the best export growth story, for example, is India, where there's a big growing middle class, a lot more consumer dollars chasing more luxury foods, and a huge demand for plant-based protein. Highly vegetarian country, so there's not money chasing meat; it's chasing other forms of protein. There is also growth in Eastern Asia, a lot of growth in the Middle East. So that growth is probably, like 5 to 10% per year, if not more. So that's the kind of the aggregate story there. Pistachios is a little bit different. Pistachios is more focused on the domestic market, and there's been a lot of domestic growth in pistachios. Some of that, or a good amount of that, can be attributed to the effective marketing from the Wonderful Company, which is actually one of the companies that we sell our pistachios through. They've done a fantastic job getting consumer awareness in the US around pistachios and the taste and the benefits and the applications. And because of that, there's like double digit consumer growth for pistachios these days.
Awesome. And now before I let you go, one person, they had missed the minimum investment. They want to know if you could restate it real quick.
Yeah, generally 50K.
Okay. That's what I thought, but I also didn't want to answer it wrong. And
No, all good.
yeah. But Josh, thank you so much for your time. And attendees, this recording will be up on Camoplan's website by the end of the week under the recorded webinar section. Um, uh, they asked for how long the minimum investment. Sorry.
What is that, like how long will they be committing to the fund, or?
I assume that's what they mean, yes.
Yeah, so how we're structured is, we're kind of structured as a holding company, and there's no guaranteed way to basically get redemptions. So there's not a contractual way to get out, but we do set up a secondaries market. So if someone invests and they want to cash out, they let us know, and we pair them to new investors. So,
Awesome.
but it is a longer term hold.
Awesome. Thank you for answering. But yes, Josh, thank you so much for your time. I really appreciate it. I certainly learned a lot today that I did not know. I also heard maybe the word pistachio more than I have in the past year alone. So, very fun. Thank you so much for sharing all this information.
Great. Well, thank you guys very much, and good questions, and looking forward to connecting later with those that are interested.
Awesome. Thanks so much, and have a good one.
Great. Thanks.